Um, my background is out of college, accounting degree, and I was right out of college, went into the IRS and got a intensive tax training and spent a lot of years doing fraud work for the IRS in the Midwest for the most part. And left the IRS in 1988, just got tired of government employment and decided I wanted to really become a speaker. And that's what I've done since then. So I travel the country talking about financial planning. I'm also a certified financial planner. I'm enrolled to practice for the IRS and la-da-da-da-da, everybody, about titles and certificates and all that, credentials. But what I want to do in this hour and 45 minutes roughly is like I want to bring you up to date on the latest things in taxation and the federal taxation. So when we got on board with this call about 30 minutes ago, several people were asking what I was going to talk about with respect to Florida tax laws. And this is not the basis of this presentation, but I'm talking about federal only. But I would like, with a tongue-in-cheek kind of sarcasm here, talk about one of our participants, not by name, who came from California and paid a lot of state income taxes to the state of California, apparently in 23, and basically gets a raise of that amount by now living in Florida. So that's the only element of state taxation I'm going to speak about. But again, everybody, tongue in cheek, the number of high profile individuals in this country that have fled higher tax states to come to lower or no income tax states like Florida, like Texas, and then lower income tax states like Georgia, Alabama, Missouri, things like that, the Carolinas. It's no surprise that one element of consideration in making a move is the tax issues, no ifs, ands, or buts. So I'm a Sarah senior instructor class. I've been so since 2002. I'm kind of the tax guy for CRS. I'm also a licensed Illinois real estate broker, but I have no time to sell because I'm on the road so much. And right now I'm in the middle of my tax practice, finishing up a lot of returns in the next couple of weeks to get my realtors in this area of the country all filed timely, things like that. My wife and I are heavy investors in rental real estate investments, residential real estate investments. And I teach courses for CRS, both tax strategies is one of them, and creating wealth through buying rentals as well. So that's what this is all about, everybody. That's kind of my background, and enough said. So I'm going to give this back to the powers to be. Do you want me to start my presentation now, or are we on hold for a few more minutes to let more people come on? It's totally up to you, Charlie, what you want to do. Let me know. You're muted, Charlie.
Okay, Chris, we're ready for you to take over. Sorry for the few minutes there of technical difficulties, but we look forward to all your wisdom. Save us some money.
Okay, we're all right. Very good. And if you listen up, everybody, it's hard not to save some money in this next hour and 45 minutes or so. Just so you all know, when we're done today, I'm going to be sending a PDF version of my entire PowerPoint slide deck, which is roughly 72 slides. And I mean, you can take all the pictures you want. You can save the screen. I don't care. But you are going to get a PDF of this. And you may get a recording of this as well. I'm not sure. They were talking about that earlier, but I can guarantee you'll at least get a PDF. And what I'm going to do is I'm going to periodically, everybody, check the chats, all right? I'm going to try to answer questions in the chat, and I'll do that periodically again as I go through this, and I'll pick off those questions I have not answered before. So with that being said, let me move into this, get control of my PowerPoints. I would just like to make this statement starting out of the box. NAR, everybody, NAR and RPAC, the Realtors Political Action Committee, and the Florida version of RPAC have been instrumental over the years in making sure that federal tax laws that benefit homeowners, real estate investors, and people in the profession of real estate benefit by these tax laws. And I'm a firm believer. In fact, Kay and I go to an RPAC function. My wife Kay is a realtor emeritus, everybody, in our board, having spent over 40 years as a realtor and one of the top producers in our board in Champaign-Urbana. But we are going to our annual fundraising gala for RPAC, in Illinois' version of it, sometime early in April. So I'm just telling you, invest in RPAC, invest in RPAC, invest in RPAC. Many of the things I'm going to talk about today are saved by RPAC and NAR in getting Congress to look at these provisions in the tax code. So I'm a big believer in it. Now, we live in interesting times, and every time I speak, everybody, it's even though you may have seen some of these slides in previous presentations, I guarantee you that I'm always trying to bring you the most current, up-to-date information. And one thing I'd like to say is there's a bill that is moving through Congress right now. The House and the Senate were on this. It was about keeping the government running, all this good stuff. But I'm really interested in whether any tax legislation made it into that budget bill. And I think not, because I would have heard by now, it's the middle of tax season. So a lot of accountants, everybody, don't have a chance to study what new tax laws are coming out. But I've heard nothing through the airwaves that there was anything in that bill of a tax matter. But if there is, after April 15th, I'll get on it with a webinar with CRS. But anyway, let me just take you back in history a little bit. So we have the previous administration, or by the Trump administration, we have the current administration. And you'll never hear me go off politically, because I don't do that. All right, I'll never criticize either administration. But we do have an 8-year period of laws that the previous administration passed. And those 8 years are 2018 through 2025. Now, I've never addressed this point before, because we've always in years prior had several years going before 2026, when this 8-year period of tax law changes goes away. But now it's the first quarter of 2024. So literally in a year and 9 months, everyone, everything's going to change. At least we think it's going to change, and go back to the way it was before 2018. All right. So we've had this 8-year window of, for the most part, benefits in the tax code, especially for businesses, especially for self-employed people like all of us. And that may come to an end on 1/1 of 26, but of course, we don't know what politicians are going to do with this in the next year and 9 months. So look at the overhead, if you would. So that tax bill that was good for 8 years was called the Tax Cut and Jobs Act. So in my notes, if you ever see TCJA, everybody, of 17, that's it, the Tax Cut and Jobs Act, which was basically for an 8-year period of time. All right. Well, in a year and 9 months, 1/1 of 26, a lot of that tax cut ends with what could happen. Everybody, look at the rest of the bullets. There's clearly a potential for higher tax rates, both marginal and capital gain rates. And the current administration class right now is talking about just that, all right? And I'm not taking sides, I'm just making an observation about what I've read, all right? So now the point is that if your financial advisor, now listen to me carefully on this, all right? So I'm a certified financial planner besides a tax guy. So if tax rates are going up in 26, 27, 28, 29, whatever, all right, then when your financial advisor recommends that you start putting more money into Roth IRAs or Roth 401ks, ROTH, everybody, Roth IRAs or Roth 401ks, the theory of what they're saying is put it in on an after-tax basis now in 24 or 25, when tax rates are lower because of the Tax Cut and Jobs Act, then have those earnings grow tax-free in higher tax rate years like 26, 27, 28, 29. And then when you take that money out, everybody, it is tax-free. That's the theory of the Roth IRA. Put the money in when your tax rate is lower, so you pull it out when your tax rates could be higher in future years. So all I'm saying is, if your financial advisor is telling you to either convert IRAs to Roth IRAs in 24 or 25 or 23, this is where this is coming from, and I tend to agree with that. All right. Now, another provision, the next bullet, everyone, is that for an 8-year period of time, the number of people that can itemize their personal deductions, and their personal deductions are charitable contributions, state and local income tax, home mortgage interest, employee business expenses, charitable contributions, if I didn't say that already, all right? The number of people that could itemize their personal deductions in that 8-year period dropped from about 33% of all 1040s filed, all Form 1040s, to about 8 to 9%. All right. So literally, a lot of people could no longer itemize their deductions, me being one of them, Kay and I being one of them, for this 8-year period of time. Well, that ends theoretically on 1/1 of 26. And if they don't change this end of the tax law of this 8-year period of time, then roughly about 33% of people will be able to itemize their personal deductions again, starting 1/1/26. And it only remains to be seen what Congress is going to do with this. All right. Now, also, they doubled the standard deduction for people that couldn't itemize their personal deductions on their 1040. They doubled the standard deduction for this 8-year period of time. All right. Well, on 1/1/26, everybody, that will be cut down in half the way it used to be before 2018. So there's a lot of people that are renters, everyone, or who have very low mortgages, or are elderly and have no mortgages, that have enjoyed this doubling of the standard deduction for this 8-year period of time, but that goes away 1/1 of 26 unless Congress continues this 8-year tax bill. Now, the SALT limitation, or by SALT. SALT stands for state and local taxes. And this is a good example of why some people are looking at what they've lost in deductions, right? And then considering moving to states where the SALT limitation is not as impactive, if there's such a word. And let me give you an example. The SALT limitation stands for state and local taxes, state and local taxes, which for all practical purposes is your state income tax and your real estate taxes on your first and second home. All right. Now, the SALT limitation put into effect for this 8-year period of time is $10,000. $10,000. So to the young woman I was talking to before we even started this morning, who in the state where she moved from, she paid $80,000 to that state, everyone, all right? They could only deduct $10,000, all right, of the 80. And then they could deduct no property taxes either on their first or second home. Well, there it is, everybody, that SALT limitation. Well, in 2026, the SALT limitation goes away, meaning that those people that live in those high income tax states with property taxes as well that are fairly high will once again write off all of state and local taxes. Everybody, I need everybody to mute here on picking up some. I'm picking up some other voices, so everybody needs to make sure they're muted. Or Charlie, you need to mute everybody if you can. Okay, now let me give a little bit better example. In 2000, literally, your instructor and his wife, everybody, Chris and Kay Bird, we paid $15,000 of state income tax to Illinois. Another 14,000 on our home, everybody in the country. That's 29. And another 6,000 on our second home in Fort Myers, Florida, in Colonial Country Club. That's 35,000 bucks. So for an 8-year period of time, we've only been able to deduct 10,000 of that 35 grand. Well, on 1/1 of 26, if they allow this SALT limitation to expire, which it will do automatically unless they continue it, Kay and Chris Bird will once again be able to deduct 35,000 bucks. All right. And then there's much, much more, class. So I've never had a slide like this up, but the reason I have this slide up is we're getting so close to 1/1 of 26. It's not even funny. And then, of course, the presidential elections in November this year will come into play here, everybody. I'm not going there, all right, but you can deduce for yourself what could happen with this depending on who becomes president in November of this year. Moving on, all right? Now, first and foremost, everybody, my entire issue is here, and I'm the tax guy, all right? You got to have a competent tax professional in your corner. And I would assume that's going to be a CPA of your choice or an enrolled agent of your choice. And either one, everybody, these are credentialed individuals with a lot of experience in doing tax representation and tax preparation. And I'd also tell you that find somebody referred to you by successful realtors in your company or in your board who do other real estate professionals. No ifs, ands, or buts, right? I do, everyone, about 40 real estate professionals, only in Illinois. I don't go out of state. Everybody don't want to learn other states' tax laws, although Florida has no state tax laws, I've already said. But you got to have somebody that understands your business. And if you are an investor in real estate, understands that as well. So what I do, and I've done this my entire career, I keep you informed about upcoming issues, everyone. And not that your accountant won't understand these issues down the road, but a lot of times people say, I tell you before your accountant tells you, just to give you a heads up, and that's good. And then feel free to show my PDF of this PowerPoint to your accountant to have a discussion about some of these points. I agree. I'll tell you right now that they will agree with 95% of what I say. And if they don't, everybody, maybe they'll say, well, I think he's right, but he may be a little aggressive or something like that. And I can accept that. I can accept that. All right. Now, setting this up, top 5 tax maneuvers that every business owner should consider. So I'm going to talk about the S corporation today, class. I strongly recommend any of my listeners that are consistently making over $70,000 or $80,000 of GCI, and obviously over 100 or 150, it becomes even a bigger issue. But you got to consider the S corporation. And it's not for everybody, but it is for most people, all right? And it goes really in combination with this 8-year run of this Tax Cut and Jobs Act that I just spoke about. And then you got to hire an aggressive but legal, everybody, CPA or enrolled agent. And you got to meet with them during the year. I meet with my clients at least 4 times a year. I want to know what they're doing before they do it. So I have input and I can help them plan instead of only reacting. If I have a client, and I don't, who just drops their stuff off right now for me to do their 2023 return, there's not much I can do to help them, everybody, because they've already done what they've done, and all I can do is react to what they've done. Number 3 is huge. Don't let the tax tail wag the dog. Don't do stupid things in the name of taxes. Now, today's March, everybody, late March. And we've got basically 3 more weeks to go before the tax season. And I'll almost guarantee you that most of my listeners on this webinar have probably not filed their returns yet because we're self-employed, because we have not paid in through withholding and things like that. So we generally put off the filing till the last minute. Well, it is what it is, everybody. But if I was speaking to you like this in November or December of last year, I would have encouraged you not to spend money just to save taxes, I would encourage you to spend money wisely to help your business grow, and then let somebody like your accountant figure out the best way to write it off. But don't do stupid things in the name of taxes. For example, I have no more need, everybody. I'm 5'5", I weigh 155 pounds. I have no need of driving a big old pickup truck that's going to get me a huge write-off that I have to have a step ladder to climb into that thing with. And you think I'm joking, all right? I've owned that pickup truck class in years past and got rid of it for just about that main reason. But if it doesn't make sense to your business, then don't think about doing it. That's all I'm trying to say. Number 4, run this like a business class, run this like a business. And you need to keep track of how you're doing every single month. Use programs like Quicken, a basic checkbook-based program, or more sophisticated version, QuickBooks, everybody, although that does take a little bit of accounting knowledge, or Mint, M-I-N-T, or another dozen programs out there, even an Excel spreadsheet of your own creation to help you keep track of your income and expenses. And then finally, number 5, everybody look at my hands if you would. I mean, I've been in this business for 35 years. I have dealt with realtors making this much in commissions, all right? And by that could be 300,000, 100,000, could be 5 million. I've dealt with them all right? But that doesn't mean anything to me. What means something to me, class, is if this is your commission level, what's your spending level, all right? Because if your spending level is this and your commission level is this, I don't care. You may be enjoying a nice lifestyle now, but you're not saving a thing for the future. You got to figure out how to make this, live on this, and invest the difference. And these 5 things are tenets, everybody. Tenets, tenets of good financial accounting. Okay, now, a couple of new things, latest from the IRS. Well, let me tell you what, the standard mileage rate for vehicles is getting so high that we really need to rethink whether we want to claim actual expenses, which is gas, oil, and I'll go through this later with some charts, everybody, or whether we want to claim 65.5 cents a mile, which was what it was last year, all right? And it just went up to 67 cents a mile for 2024. And I'm telling you, if you own a vehicle that you paid, I'm going to tell you, less than $40,000 for your business, and you put 15 to 20, 25,000 miles on that vehicle a year, I'd really, if I was your accountant, run the numbers as to whether the standard mileage rate is the best way to go or whether to claim actual expenses and depreciation, etc. But I'm just telling you, this deduction is now out of sight in terms of how big it is per mile. No ifs, ands, or buts. Number 2 in the gray box, everyone, the IRS was going to come out with some pretty stringent requirements on the use of 1099-Ks. And this is if you sell something on eBay, everybody, or on the internet, or you get paid with a MasterCard, Visa, American Express, something like that. The IRS, Congress and the IRS wanted to nail us, everybody, if we received more than $600 in a year. Well, due to public outcry on this, they put this off until 1/1 of 25, as I understand it. So we're still okay, everybody, on the current, and we don't have to worry about that lousy $600 rule. All right, you might want to talk to your accountant about that. But I would like to say this. If you are using somebody in your business, like a photographer, everyone, or like a stager or something like that, who's not an employee of yours, and you pay them now $600 or more in 23 or 24, then you may be required to issue them a 1099 NEC, which stands for non-employee compensation. Now, that's not the same as the 1099-K in front of you, but I'm telling you the penalties are getting to be pretty atrocious if you do not issue these 1099s to people that work for you in your business who are not employees if you get caught by an IRS audit. And there are exceptions if the people are incorporated, things like that. For example, they're a C Corp or an S corporation or an LLC that is elected to be taxed as a C or S corporation. You're not required to issue the 1099 NEC. But I'm telling you that most of my realtor clients that returns for every year, I issue these 1099 NECs to keep my problem. And again, everybody, I'm picking up sound from somebody that's not muted, and I'm just telling you, it could be distracting for people. Finally, in the yellow box, the update on the employee retention credit. This is probably not too relevant to this group.
Chris, you're on mute.
Okay, so I just got muted a second ago, I think by Charlie. Thank you. All right. And I hope that you didn't miss a lot of mine, but I think when Charlie muted everybody, I got muted as well. So Tammy, wait, shake your head yes if you can hear me again, Tammy, if you would. All right, excellent. So anyway, back to the yellow box. I don't think this applies to any of my listeners today, but the employee retention credit has been the subject of a lot of fraud. And if you've read the articles recently about the fraud that has taken place in all the pandemic government money that was distributed, this is part of it, everyone. And it was designed for employers who kept employees on the payroll during the pandemic of 20 and 21. So that's what it's all about. All right. So if you've claimed this credit, I'm telling you that you could be a target of the IRS. If you haven't claimed the credit, then you can't be. It's as simple as that. But there's been a lot of fraud there. All right, I move on to the next slide. Now, something that has come up since I talked to any of you last year, and especially a year ago, March, everyone, is this new Corporate Transparency Act. And I just like to make a point, class. A lot of this has been blown out of proportion. All right. So look at this slide. Just let me tell you what I'm talking about. And this is absolutely brand new. Everybody started on 1/1 of 24. Now, the government of this country is trying to get a handle, if that's even possible, all right, on illegal money coming into this country. Everybody, drugs, human trafficking, sex trafficking, from any illegal source. They're trying to get a handle on it because you obviously know this is never being run through a tax return at all. So if you look at the overhead, the word FinCEN stands for Financial Crimes Network. That's what FinCEN stands for. It is a division of the U.S. Treasury Department, and you can go to fincen.gov and look up what I'm talking about. This is not an IRS requirement, but you may have your accountant fill out this new report that is supposed to be filed in a 12-month period starting 1/1/24 and 12/31 of 24. Now, what is this all about? All right. It's all about anybody that filed with a Secretary of State to become an entity. So from a federal standpoint, this would be all your LLCs, limited liability companies. It would be all your S corporations. It would be all your C corporations. It would be 72% of all your partnerships. And in Florida, everyone, you have what is called a PA, a public association or something like that. If any entity, this is all I can say about this, if you went through the Secretary of State of Florida to become an entity with the state of Florida, then you're under this FinCEN requirement. All right. Now look at the second bullet, please. For all of those entities that were in existence as of 12/31 of 23, you are required to go to fincin.gov and file what is referred to as the BOI report, the Beneficial Ownership Information Report. And you're supposed to file information, 25 questions on every owner or person in control of that entity. And you have a 12-month period to do this. Now, just to make sure that you don't think I'm blowing this out of proportion, every live seminar I've done since 1/1/24, several people have come up at lunch and said, Chris, while you were talking, we went to fincin.gov and filed the report. All right. So everybody, it's just not that big a deal. It just takes about 10 minutes to do. Get her done and get her done, everybody. Get her done. And I realize that some of you feel this is government overreach, which I do, but I'm not going to fight City Hall over this either way. And I've already done a class, and I've told all my clients to get her done. And if they need my help, I'll help them. But it's just not that big a deal. All right. Now, I will tell you this all honesty, that there was a court case in Alabama in the last 30 to 60 days where several people sued everybody, the federal government, and got I guess I'm gonna say restraining order. That's not the right term, but basically the court order was that they felt this was government overreach, and the FinCEN has issued a statement that those particular people involved in that lawsuit out of Alabama do not have to file that report pending the resolution of that court case. All right. But it only applies to those people in Alabama, the few that sued. But maybe that will be a growing trend. Who knows? All right. Anyway, I've already filed the 2 reports on my wife and I. I've got to do some on some LLCs for some of our rental properties, but it's no big deal. All right. Now, one more thing. Next bullet. For those entities that start in business on 1/1/24 or later, everybody. So any of you that formed an LLC, an S corporation, a PA, whatsoever, you've only got 90 days from the day you're notified by your Secretary of State that your entity is in effect to file that report with the federal government. So it is what it is, but it's no big deal, everybody. And I'm telling my clients file it themselves, and it just doesn't take that much time. All right. But look at the last bullet. Big Brother is watching. Oh, yeah. All right. Okay. Now, it's late March of 2024. So what do we do for 23, class? And we don't have a lot of choices. All right. Because this is not December of 23. So after year-end tax moves that always make the list. All right. So I go 2 ways. If you had a really good year financially in 2023, then what you may want to do, class, is invest more in your tax deductible retirement plan, like a SEP IRA or a 401k. And I'll talk about the differences in these plans later in my material. All right. But you can still put the money in 24 and deduct it on your 23 return. That's what I'm talking about. All right. And then for assets that you bought in 2023, right? Not for assets bought in 2024, but assets bought in 2023, you want to talk to your accountant about being more aggressive with your depreciation and claim higher depreciation deductions, faster depreciation through things like bonus depreciation and 179, things I'm going to talk about, all right, to lower your marginal tax rate in 2023. Those are about the only things you can really do now for last year, all right? Well, let's go the other way. What if you were off last year, class? And I'll be totally honest with you, and I know I'm talking to Florida, all right? But I'm in central Illinois, and everyone, no exception, every one of my real estate clients, everyone had a down year in 23 compared to 2022. Why? Everybody, the big 3: high mortgage rates, low inventory, high price of real estate. The current homeowners unwillingness to go from a 3% mortgage to a 6 or 7% mortgage by moving up everyone. I mean, this is what's affected markets all around this country. And I can't speak for your market. I have no personal experience with that. But if your 2023 was an off year, then that would have been the year to do a conversion of an IRA to a Roth IRA. And that's the first bullet on the screen. However, under the law, that must have been done by December 31st of 2023. So you might want to look at this for 2024 if 2024 is looking like it's going to be a weak year as well. All right. And then consider slower methods of depreciation in 2023 because your tax rate is already lower, but I've got a screen coming up of that in just a minute. If your tax rate is already lower, that's not the year you want to be aggressive with your depreciation. And I'm going back a screen like if you were having a good financial year. So, things change, everybody. In good income years and high tax rate years, we have to think one way, right? In low tax rate years, we have to think of it differently. All right. Now, let me be very specific about this. All right. Look at this slide, if you would. Just 4 things to keep remember. All right. And this goes without saying, everybody. It's a truism in my financial ethics. All right. In the blue box, the problems of having money always outweigh the problems of not having money. Duh. That's no deep statement. All right. But my point is the green box, all right, the light green box in the upper right-hand corner. Be proud of the fact that you have to pay a lot of taxes. Now, I know I grate people when I say this, everyone, but let me tell you what, all right, you owe a lot of taxes. You made a lot of money. And I'll take that any day over the opposite, everybody. And I've got people every year that want me to become their accountant. And let me just say this real quickly. Accountants in general are not taking on new clients. All right. Everyone in my peer group, everybody, has enough clients. I turned down one yesterday who called, please. No, I've got enough that I am comfortably busy and I just don't want to grow my practice. And you have no idea the number of people out there that feel the same way in my business right now. So good luck, everybody. If you're looking for an accountant, it may not be as easy as you think. But here's the deal, all right? People have come to me and said, Chris, I don't believe in paying taxes. And right out of the comment, right out of the box, I'll say that we have no business wasting your time or my time. I don't want people as clients who want to pay no taxes because they're probably not making money, right? Or if they are, then they're going to engage in stupid things, tax tail wagging the dog to try to take their tax down to zero, all right? So when you got to write that check for $80,000, all right, be happy, everybody, that you wrote that check and hopefully you didn't spend it on frivolous things where you don't have it. That is a huge point with me. Paying taxes is good, all right? And then look at the bottom left-hand corner. Don't do stupid things in the name of taxes. Now, look at this slide, if you would. Too many taxpayers want to pay the lowest, if any, amount of taxes each year, all right? The next box I've already talked about. Paying taxes is a good thing. So now look at the third box. Let's discuss the theory of not eliminating the benefits of paying taxes at the lower tax brackets, where probably those brackets will be higher in future years. And I've made that case already. Now, look at this, everybody. What I've got now is here are your tax rates for 2023. All right. And I'm trying to get rid of the box. There it is. All right. So this is what all of you are going to face when you file your returns for 2023. Notice the left-hand column, everyone, 10 to 37%. And that's what people are worried about will go up starting 1/1 of 26. And then notice the level of income for single filers, the level of income for married filers filing joint returns, and the level for head of household. And let me tell you what's not on this chart, everybody, is married filing separately. And I got to tell you, just tongue in cheek, just for a second, I just got done yesterday with doing a married filing separate couple, all right? And we accountants don't do this very often, and I hadn't done one in a while, so I really had to watch my methodology when I was doing it. But up front, I told the couple, both of them, you're gonna pay more taxes. You're gonna pay more taxes. And the answer was, we don't care, all right? We are living separately. We don't plan a divorce, but you never know. But we do want to file separate. And by God, they did, everybody. I did their return jointly and I did it separately. And it cost them several $1,000s between them more. All right. But that was it. They wanted to do it. So I'm just telling you a general rule of thumb, and why most people don't file married files separately is it does cost them more taxes. But obviously in this situation, there's a relationship issue that's driving the situation. Now, let's just focus on one column here, and don't be insulted, everybody, if I choose married filing joint, just as an example. All right. Now, notice the rates from 10 to 37%. And here's what I'm going to tell you. Let's say that that married couple finds themselves in the 24% rate in 2023. All right. And everyone, now assume with me, and I'm going to hit this harder with an example a little bit later. Assume with me that they bought the right kind of vehicle, which gets them a $60,000 upfront deduction, the heavy SUV. All right. Now look at that middle chart. At the 24% rate, their income, their taxable income is going to be between $190,750 to $364. So let's assume, everybody, that they are at $250,000, right? Just to make it easy. And we're looking at a $60,000 deduction. Well, 250 minus 60 is 190 grand. And the lion's share of that 60 grand is at the 24% bracket, everybody. So you multiply 60% time, or 60,000 times 24%, you're looking at close to a $15,000 tax savings. Now I want to change that. Now, assume with me that that married couple, everybody, has $90,000 of taxable income before we consider that truck of 60 grand. All right. Well, everybody, 90 minus 60 would take them down to 30. Now look at that middle row, if you would, that middle column. Clearly, they would be in the 12% tax bracket, and 60,000 times 12,000 only saves them $7,200 in taxes. Half what it would save to the couple making a lot more money. So class, this is being penny wise and pound foolish, but I'm telling you that I would be trying to talk that couple in that 90,000 range from even buying that heavy vehicle if I could win the argument, because I'd rather them put money into their business through coaching and advertising than buy that stupid heavy vehicle in the name of taxes. So everybody, your accountants will love me for talking about this, because this is the way we accountants think. All right. Just remember this. We want your big write-offs at higher marginal tax rates. We don't want your big write-offs at lower marginal tax rates. Now, I also call this class, I mean, this is priceless. All right. I call this push-pull. All right. And let me just tell you what I mean. Around October or November every year, I look at my receipts, everybody, for the year, and I do really well. All right. But I generally push all of my billables from October, November, and December into the following year. All right. And therefore, I push that income off into the following year. Now, hear me out if you would. Well, my gosh, everybody, a year in October of 25, all right? If I see tax rates have jumped up considerably in 2026, then guess what I won't do in 2025, everybody? I will not push that income off into 2026. I'll pull it back into 2025. So I'm just telling you, the beauty of what I'm talking about is, as self-employed people, we have the ability to push, pull, and legally manipulate our tax situation every year. And that's just cool, cool, cool. All right, look at this next slide, class. And this is what I have been all over the country talking about for the last literally 6 months. And not all of these apply to Floridians, all right? So I'll tell you which ones don't. But I'm going to tear apart these things as I go through here in the next hour. So depreciation 179 and bonus depreciation, class, that's how to get big write-offs, right? The 20% qualified business income deduction, good for 8 years. I'm going to talk about that. The Augusta rule, class, the Masters comes up in another week, all right? So that's where the Augusta rule comes from, the Masters tournament in Augusta, Georgia every year. Cost segregation studies, the S Corporation, I told you I'd be talking about that. The 1031 real estate exchange, the real estate professional status, stepped up basis, everybody, when you inherit properties from a decedent, you get a huge tax advantage, class, a huge tax advantage, all right? For you heavy high income producers, all right? Number 9, the cash balance defined benefit plan is something I'll mention briefly as compared to a SEP IRA or a 401k. And finally, number 10, the pass-through entity tax loophole is inapplicable to Florida and Floridians because you have no state income tax. It's very applicable to states that have high taxes like California, New York, New Jersey, Illinois, etc. Right? So here we go into each one of these. Now, class, I have very little today to talk that hurts you, right? In fact, the only thing that is really kind of a nuisance is that FinCEN BOI report I referred to earlier. And that's just about it, everybody. Everything else is good. So in the last 10 or 12 years, Congress has seen fit to give us generous depreciation deductions of things we buy for our businesses, real estate, speaking, etc., and rental properties as well. And they do this, everyone, primarily through the Section 179 deduction, which I'm going to talk about first, and then bonus depreciation, which I'll talk about next. All right. Now, here's the point. Congress raised the 179 deduction limit from around $500,000 to over $1 million. Not that that helps us, class, right? But it does help people that are capital intensive businesses. For example, a home builder that buys 3 skid steers, everybody, and a couple of backhoes and things like this, right? Or a company that buys a crane for commercial real estate construction. What they've done, right, in the orange box at the top, for owners and lessors and lessees of commercial real estate, not residential rental, right, but commercial real estate, they've given them the ability to write off in the first year of spending money on a new roof for an existing commercial real estate building, or replacement HVAC systems, everyone, security systems, etc. So if somebody puts a $400,000 new whale skin roof, you know, that's the rubber covering, everybody, on a flat commercial roof, they could choose to write the entire $400,000 off in the first year as a current year deduction, or depreciate it over, I guess, 15 or 20 years. The same with a $200,000 new central air conditioning system or various units on the roof, everyone. They could choose to depreciate that slowly or write it off the first year. Congress gives you the choice. It's nice. When would you want to write it off, everybody? When your marginal tax rates are high. When would you go slowly? If your marginal rates are lower or you expect your income to go up over that 15 or 20 year period of time. Now, the mauve, or whatever color that you call that middle, whatever, I'm going to call it mauve, all right? applies to residential rental real estate. And this is in my wheelhouse. All right. Class, one of the mistakes, and I'll tell you right now, for me and Kay and I, in our life, everybody, is not buying one, farmland, all right, and two, some commercial real estate properties. One of my big misses, everybody, is not buying a storage, commercial storage unit that I had the opportunity to buy 4 or 5 years ago. And there are extenuating circumstances, which why I didn't, but I wish I had. All right. Those are a couple of my misses. But we own a lot of residential rentals where people live on a non-transient basis, everybody. So you have 30-day leases, you have a year lease, and all of ours are 1-year leases. And I got to tell you that the humor, everybody, of owning residential rental real estate. We have a bunch in our town of Champaign-Urbana, and I get a note from one of my tenants. I mean, you got to live this, all right? I get a note from one of my tenants, Chris, we looked outside and our mailbox is down. Can you get it fixed so we can get our mail? And this is a doctor client of mine, all right? And I said, send me a picture, all right? And everybody, boom, this thing's flat on the ground, all right? And the 4x4 post that the fiberglass, whatever, fits over was broken over. Whereby somebody backed into the mailbox, no ifs, ands, or buts, all right? And I had to throw out the question, who did it? All right, because my gosh, if they did it, everybody, guess who's paying for the service of having it repaired? And of course, they denied culpability, and I can't challenge them, class, on that, So anyway, my maintenance guy goes over there at 2:30 this afternoon to put a new 4x4 in there and put the mailbox back up. So that's the joys of owning rental real estate and managing them yourselves. Okay, back to my presentation in the mauve box. So before 2018, before this 8-year run, right, we had to write off all of our things like appliances and carpeting and drapery, everything you see listed in that mauve middle box, right? We had to write that off over 5 years, right? And everybody, starting in 2018, we can choose to write the whole thing off in one time, all right? And this kind of ties into the real estate professional rule I'm going to cover later in my material. But this is big news, everybody. And I live this. And look at the list. Appliances, ceiling fans, all floor coverings, blinds, outside equipment, mowers, snow blowers, trailers to haul, pickup trucks. I have written all of that stuff off in that middle box in the year I bought them, as opposed to depreciating them over 5 years. And either way, you're going to get the write-off, but it's in the high marginal years, high marginal tax rate years, you want to write it off if you can. True story. About 3 or 4 years ago, Kay and I spent $66,000 on all new stainless steel profile, GE profile appliances, everyone. And that's to the tune of about $5,500 to a rental. So real close to 11 or 12 rentals. We applianced all of our rentals in this one area. And the question was, right, do we depreciate the 66 grand or do we write it off all in 1 year? And because of that middle box, everybody, we chose to write it all off that 1 year. And that saved us a lot of taxes that year because we are at very high marginal rates. Look at the gray box, all right? The point is, everyone, that this deduction, the 179 deduction and bonus depreciation, which I'll mention in just a minute, if you want to write it off the first year, your accountants can do it under either 179 or bonus depreciation. I guarantee it, all right? Now, what about bonus depreciation? It's 100% of the cost of all those things that I just talked about, right? But the only trouble, class, is that bonus depreciation used to be 100%. It actually dropped to 80% in 2023. It drops down to 60% in 2024. However, there was a bill in Congress earlier this year, and we're all wondering what's going to happen to this bill. It was HR 7024, wanted to reverse the 100 going to 80 and the 80 going to 60. But that I know of, as of this morning, nothing has changed. And this weakens the benefit of bonus depreciation. However, I'm going back a screen. You still can get it all under section 179. All right. Anyway, we're all good, everybody, just either way. Now, I've never taken you here before, but I want to mention this to you. This is a lifesaver, and I use it a lot. And I just, in the last 2 months, everybody doing tax returns, I've used this next section probably 24 times, right? It's called the de minimis safe harbor deduction. This has been around since 2014 or 2015. And the reason I'm bringing this up is a lot of accountants have forgotten about this. And that's why I'm bringing it up, for you to mention it to your accountant. Here's the question. Are we using the de minimis safe harbor deduction? That's the question to your accountant. Are we using the de minimis safe harbor deduction? Now, let me give an example. It used to be a $500 limit per item, and it was increased fivefold, everybody, to $2,500. Anything you spend money on, like an item of $2,500 or less, you can write off under the de minimis safe harbor deduction, no questions asked by the IRS. It's just a great little safe harbor deduction, all right? Now, look at the bullet, look at the overhead if you would. This is a great tax equalizer, especially on your real estate rentals, as well as depreciable items purchased for your business of real estate, staging, speaking, whatever, all right? And then look at the last sentence. I will discuss how this could apply to a rehab, all right? Now, I'm going to come back and visit the rehab when I get done with my little presentation on this topic, all right? Now, the $2,500 deduction. This applies to each invoice, everybody, an invoice. Or, and the real kicker here is to each item on the invoice if separately stated. All right, just think about that. Or to each item on the invoice if separately stated. So for your businesses, it would be copiers, everybody, computers, desks, file cabinets, equipment, smartphones, etc. For your rentals, it would be your appliances, carpet, windows, doors, etc. Now, look at the next bullet, please. Remember, all of your repairs and maintenance are already fully deductible, all right? This safe harbor deduction is for the purchase of tangible property like equipment that might have to be depreciated if it were not for this deduction. And let me give you some specific examples. So you go to Lowe's, everybody, Home Depot, or your local appliance store, right? And you buy 10 refrigerators for your rentals. And these refrigerators are $800 a piece. So there's not much of a refrigerator there, $800. But there you go, right? Now, what you don't want is an invoice that says 10 refrigerators at 800 equals 8,000, right? Because that won't qualify for the safe harbor. But chances are there will be 10 different SKUs, everybody, serial numbers of each one of those refrigerators, all right? So if there's 10 SKUs on that invoice, remember, or each item on the invoice, now you can write off the entire $8,000, no questions asked by the IRS, all right? That's what I'm talking about. And there's that $66,000 of GE profile appliances. Every one of those appliances had a serial number, everybody. They were on 4 or 5 different invoices. We claimed it all right? Now, look at this, some planning. So you've had one of your rentals or your office, everybody, carpet and installation, $3,200. Well, $3,200 is more than $2,500, so you don't qualify. And understand this, you don't get the first $2,500. It's either yes or no. If it's $2,500 or less, yes. If it's $2,501 or more, no. All right. So now what you got to do is you got to go back to that company and say, I need you to break down that invoice, all right? And give me the amount for the carpet and the amount for the labor. And it comes back, everybody, $24,000 and $800, 2 items on the invoice. Now you can write off the 24 and you can write off the 800. All right. There it is in a nutshell. All right. The election is an annual election. So in my computer software, I use a program out of the southeast part of the country in the Carolinas by the name of Drake, D-R-A-K-E. Once I make this selection, it follows through every single year unless I undo it, all right? But your account needs to make the election to use the de minimis safe harbor. All right, the next item, everybody. So depreciation was number one, all right? We talked about that. Now, the qualified business income deduction, and I really got to talk about this class, right? This is an 8-year window, right? Created by the previous administration as a payback to the risk takers in business in this country, self-employed people like ourselves. Unbelievable. And this has been one of the most significant tax savings mechanisms that I've ever seen in my career, that went into effect in 18 and ends on 12/31 of 25. So the previous administration started, the present administration continued it, all right, to give credit to both, but it ends on 1/1 of 26. Now, look at the overhead, if you would. This is a 20% deduction of your profit from selling real estate, from speaking, for a dentist, everybody, for an attorney. Every business qualifies. Are you with me with different little considerations? But I will tell you this. I'll go back to my first slide earlier today, everyone. Congress did not intend for people in the real estate industry to fully benefit like other professions. And NAR and RPAC, everybody went to bat and fought for this and made sure that realtors got the full benefit of this deduction. Now, it's 20%, 20%, 20%. What does that mean? That means that if your profit from selling real estate is $100,000, you get a front page deduction approximately on line 13 of your 1040 called the qualified business income deduction of $20,000. If your profit was 100 grand, you get a deduction of 20%. If your profit was 300 grand, you get a deduction of 60 grand for nothing. All right. And I'll tell you right now, class, 18, 19, 20, 21, 22, and coming up to 23, I'm telling you that I've saved over $30,000 to $35,000 of taxes because of this deduction since 2018. Your accountant could not have missed this. The software would not allow them to do it. If you did your own return using TurboTax, you could not have missed this, all right? It's just cool, cool, and cool. Now, what else, everybody? All right. The big question when this 20% came out was whether our rental properties would qualify for this deduction. And in 2019, the IRS clarified that if you have enough rentals, now they don't define what is enough rentals, all right, but they do put in an hour requirement, that if you spend at least 250 hours managing your rentals, your rental profits qualify for this deduction. So I'll guarantee you, class, Kay and I, with a bunch of rentals, we claim this 20% on our rental property profits as well. But if you only own 1 or 2 rentals, and I mean a single family or a duplex, something like that, chances are you probably don't meet the 250-hour management time requirement and don't qualify. But if you own a lot of rentals and you've got profits on your Schedule E of your 1040, you need to talk to your accountant about why we're not using that 20% deduction. All right, next issue, everybody. Number 3, the Augusta rule. And this has its roots in the Masters tournament that is in early April of this year. All right, now I spoke for Market House Real. Excuse me. I spoke for. I'm going to go get a glass of water. Don't leave. I'll be right back. I'm back and I apologize. Now, back to the Masters tournament. Several summers ago, I spoke for a very successful real estate firm. So here's a shout out by the name of Market House Realty in Augusta, Georgia. And I already knew about this, the Augusta rule, but boy, there it was in full force. Everybody, the realtors that were there telling me about it. 1,100 homes, I'm told, go on the rental market for the 8-day run of the Masters tournament every year. And the average rental income is about $15,000 for that 8 days. And here's the tax law class, section 280A of the Internal Revenue Code. If you rent out your principal residence or second home, only your principal residence or second home, right? For less than 15 days a year, right? Then the rental income is tax-free. So class, in that example, that $15,000 that 1,100 homeowners on average are receiving is tax-free. And I'm told that people are making 5 or 6 months of mortgage payments on income they don't have to pay tax on. And that's pretty cool. No ifs, ands, or buts. Now, from a humor standpoint, I have heard, everybody, that Tiger Woods, all right, rents the same home, big home for his entourage every year for $60,000. All right, the same home. How would you like to have 60 grand of tax-free income every year? I think it's pretty cool. All right. Now we're going to get a little aggressive, but aggressively legal. So now here is the theory, and everybody, you can Google me, you can TikTok me on this if you want to, but there are thousands of articles on what I'm going to mention now. So if you are an entity like an S corporation or a partnership, all right, if you're one of those two, or an LLC taxed as an S corporation or a partnership, consider renting your home out to your S corporation or partnership for office meetings, training, whatever, everybody. You rent that space in your home to your corporation for less than 15 days a year. The rent would be deductible by your corporation and tax-free to you under the Augusta rule. And my authority for teaching this class is twofold. If you look at the slides, all right, there is a private letter ruling back in 1980, late 80, where an S corporation professional photographer rented his home for shoots, everybody, professional shoots, all right, photography, for less than 15 days a year. The rent was reasonable, and the IRS says, you're good, all right? And that's what started this back in 1980. Then, in the summer of 2023, the Sinopoli case, everyone, reinforced that this is legitimate. The only trouble that Sinopoli got into, hear me clearly, they rented their home to their corporation for like 13 days for $100,000 of rent, right? So the corporation deducted $100,000 and they did not pick it up as income because of the Augusta rule. Well, they got audited by the IRS for whatever reason, and the IRS found this and took them to court, everybody, and the court said, hey, renting is okay under the Augusta rule, but you paid yourself too much rent. And the court held that the proper amount of rent should have been around $11,000. So the court allowed 11 deductible by the corporation, 11 tax-free to the owner, all right, and denied the deduction for the remaining $89,000. But they held that the Augusta rule was very much valid, but the rent has to be reasonable. Now, what I'm going to do, class, I'm going to dive away from my PowerPoint for just a second, all right? And I'm going to take a look at the chat questions just to see if there's anything I can answer very quickly. I'm just seeing a lot of good mornings. Oh, very good. Okay, here's the first question. If you've already retired from your career and are now in real estate, can you still contribute to a Roth? The answer is yes. You have to have earned income, everybody. Right? So when you have a job, earned income is your W-2 salary. But when you have self-employment income and you're now in real estate, that qualifies you for a Roth. Now, there are limitations on your income to be able to contribute to your Roth. There are limitations on your income, and I'd honestly have to look them up, but they change every year. There are limitations on income to do a contributory Roth. There are no income limits on doing an IRA conversion to a Roth. So talk to your financial advisor. Chris, what happened with your audio? Well, I think I got cut off a little bit. Okay, now they're saying we're good. I'm just looking for questions. Can the 15 days be one monthly, or do they have to be consecutive? I like that question, everybody, and they can be any way you want them to be. They do not have to be consecutive. And remember, it's not 15, everybody, it's less than 15, all right? But it can be one day a month. The answer is yes, all right? And that's a question on the Augusta rule. All right, I'm now getting rid of those questions. Back to my slides. All right. The next thing, everybody, in commercial real estate arena, all right, the hottest thing going right now is called cost segregation studies. And let me just tell you what this is all about. And first, an example. I was doing a seminar in Phoenix, Arizona for a real estate firm back in September, October last year. And the owner of this firm said that she did not have to pay taxes in 22 or 23, 2 years. And she's a big income earner, but she did not have to pay any taxes in 22 or 23 because she had done a cost segregation study of every commercial building that she owned. And the deduction removed all of her taxes for a 2-year period of time. All right. Now, so what did she do? So look at the overhead, if you would. The real ticket to accelerating depreciation on large commercial buildings or residential real rental complexes. All right. The objective of the cost segregation study. Now go with me on this, class. A commercial building is depreciable over 39 years. Residential rental is depreciated over 27.5 years. That's the law, right? But now think about things that are inside a commercial building and the things that are inside a residential building. And don't think about what's real estate for real estate law and what's personal property for real estate law, everybody. We're talking about taxes. And this taxes are totally different than the comparable real estate laws. So look at the second paragraph, please. The objective of the cost segregation study is to get as much of the cost of the building out of what would be depreciable over 27.5 years or 39 years and get it into the shorter lived assets that are depreciable over 3, 5, 7, 10, or 15 years, right? And here's the truism in tax law, everybody. The longer the life of a depreciable asset, the smaller the deduction. The longer the life, the smaller the deduction. Now, let me go the other way. The shorter the life, the larger the deduction. So the theory of this, and I'll just give you a number real quickly. Let's just say that you had a $3 million residential complex that you bought in the last 3 or 4 years, all right? Or you're considering buying right now. $3 million. And in comes a cost segregation study company, and they cost money, everybody. They're not cheap. And they tell you that of the $3 million, 700,000, I'm just shooting numbers off, right? 700,000 is attributable to what could be depreciated over 3, 5, 7, 10, 15-year property, all right? And what you then get to do is you get to choose whether to depreciate that 700 grand over those various lives or to claim it all in 1 year, right? And everybody, a $700,000 deduction in 1 year is pretty cool. And I'll give you a prime example of this. I got a call from a realtor who was being coached by a friend of mine, Dirk Zeller out of Bend, Oregon. There's a shout out, everybody. Dirk Zeller out of Bend, Oregon. And she had a really big 22 year, right? Big, right? And she owed like $250,000, $300,000 taxes. She called me in March of 23 and said, Chris, is it too late to do a cost segregation study for 2022? And I said, absolutely not. All right. Now, I don't do these, everybody. You have to go to a company that does these. All right. And I referred her to a company, and she never called me back. But from what she was telling me, I'll lay you money she could have cut 70 to 100,000 out of her $250,000 to $300,000 liability by having a cost segregation study done in March of 23 for 2022, if that is indeed what she ended up doing. And I'll lay you money she did. Now, the average cost of a study is generally anywhere from 1/7 to 1/10 of the tax savings. So if she saved 70 grand, everybody, it could have easily cost her 5 to 7 grand to have that that study done. And again, the tax savings are just literally incredible, right? And look at the third bullet. The result is a significant deduction attributable to the faster depreciation of the short-lived assets, and in many cases, a current deduction for the fast and missed depreciation in earlier years. You've got to contact, now I want to just set this up, class. There are DIY cost segregation studies. Do it yourself, all right? I highly recommend you pay the freight and get it done right, all right? You get audited by, and you've done a DIY, I would think you're much more susceptible to challenge by the IRS if you paid the freight and went with an established company. And that's just my way of doing things, everybody. Get it done right. You don't incorporate yourself, you go to an attorney, all right? You don't incorporate yourself by going to an accountant, you go to the attorney. You set up that relationship. Same with a cost segregation study. And I have no financial interest in any of them. And don't mention my name, everybody. I don't take referrals, and I'm not selling you anything. I'm just trying to give you good advice. All right. Next, everyone, let's go into my fourth or fifth item, the choice of business entity. And anybody new to real estate, probably not yet on this, everybody, but anybody that's been in real estate, I recommend you consider the S corporation if you're making over 70 or 80 a year in GCI from your sponsoring broker. Well, look at the current mix, everybody, of people, how they file their tax returns. Clearly, 2/3 file as sole proprietors. 12% file as S corporations. Another 6% is LLCs, 9% partnerships, et cetera, et cetera. And what I'm trying to do is get as many of you to move from the 67% to the 12% if you're making really good money. Why? To save Social Security taxes. Now, clearly, this is not something you got to do, everybody, all right? But it's something that you at least should talk to your accountant about. That's all I'm trying to say. It doesn't necessarily work for 100 people out of 100, but I will tell you, it probably works for 90 out of 100 every single time. And I will tell you this, every one of my real estate clients in that I do, this stack of returns over here, all but 2 of them are S corporations, all right? And the 2 that are not S corporations are kind of bowing out of real estate. Both got full-time jobs. One is a nurse, one working now with the county of Champaign. And they told me years ago that they didn't think that real estate was going to be their forte. So I never went to the S corporation. Why spend the money, everybody, if they're going to be basically getting out of the business? And I'm glad I didn't, because they both are leaving the business of real estate. All right, now why? All right. Well, here's why to become an S corporation. But look at the third line down, if you would. The entire issue is simply this. Done properly, it's an opportunity to reduce your Social Security tax liability. That's it, everybody. That is it. The chance to reduce your Social Security tax liability through the salary, how much salary you take versus how much distributions you take that are not salary, right? But the IRS is careful to tell you that you must take a reasonable salary, but they're not willing, or they don't give us any idea of what that means, everybody. They just leave it in the air, right? So this leaves it to the discretion of your accountant and you to discuss. And every year with every one of my S corporations, their salary is generally different than what it was in the previous year based on their commission income, things like this. Hey, I'm not an attorney, so I'm not going to go into some degree of liability protection, but I will tell you this. Your instructor is an S corporation. I have been since 1991. I have saved over $200,000 in Social Security taxes in that 33-year stretch. And every bit of that 200,000 has gone into investment real estate. So everybody, one of the nothing's perfect, nothing's cheap, nothing's free. So if you go with me on this, you will be paying in less. You will be reducing your eventual Social Security benefits. Okay, there's the price you pay. So the other side of the coin is you've got to take the savings every year and invest the money in something that's going to grow. All right. But if you're going to blow that money, everybody, on discretionary spending, probably I would not recommend you do it. All right. All right. Now, here's an example, and I'm going to go with two numbers. But first of all, let's say that your income, everybody, your profit, okay, is 300 grand. And I'll guarantee you, I'm talking to Florida Realtors class, and the price of your real estate, especially where you live, all right, where you work. And I know everybody's not from Pensacola area, but there was an interesting article on the internet, everyone, just this last week. So it must be true that Pensacola is becoming the new Miami. That was an article on the internet in terms of real estate. Charlie, shake your head if you saw that article. Pensacola is becoming the new Miami. All right. So he just acknowledged that. All right. Now, I know I have people from Tampa, everybody, Ocala, things like that. So I know everybody's not from Pensacola. But as an owner of, and let me just kind of digress for just a minute, as an owner of two beautiful properties, a rental and a second home in Fort Myers, Florida, Colonial Country Club. What's interesting right now is all of the verbiage you read about people fleeing Florida because of hurricanes, everybody, insurance problems. Just it's interesting how markets change is all I got to say. And it is what it is, but I'm a constant, I just suck that information. I'm a sponge, reading what different people have to say. All right. But my point in even bringing this up is there's a lot of you making a lot of money, class. So I'm starting off with a $300,000 profit, and then I'm going to drop it down to 100,000. All right. But if you make a $300,000 profit, I would have you take out a $130,000 reasonable salary. That's what I would have you take out as a salary. All right. Now, you would pay Social Security taxes on that salary of $19,890. Right. And then assuming you needed the rest of the money, everybody, I'd have you take out the other 170 as distributions. And you're going to pay income tax on the entire 300, but you're only going to pay Social Security taxes on the 130. All right. Now, ignore what I'm saying. All right. Ignore what I'm saying. Look at the next slide. All right. If you stay a sole proprietor or an LLC taxed as a sole proprietor, then you pay Social Security taxes on the entire 300 grand, which in this case, everybody, would be almost 28,000 bucks. My numbers are absolutely correct, everybody. I mean, there's no plus or minus there. it is an absolute real number there. You're going to save about $8,000 in the process. And then look at the last paragraph. The current administration class has kind of put a target on S corporation backs because of exactly what I'm talking about. They would love to have that extra $8,000 into Social Security every single year. For all I know of, there could be a huge S corporation audit program by the IRS down the road, but they've been threatening this my entire career and nothing has happened yet. So what can I tell you? I leave this tongue in cheek, everyone, and don't anybody say I'm criticizing. I'm just stating the obvious, and look this up if you challenge me on this. But type into the internet on your own if you want the Joe Biden S corporation issue. All right, and true story, everybody, that before he became president, Jill and Joe were on the speaking circuit and made over a 3-year period of time, $13 million. And their accountant formed an S corporation for them. Everybody living the dream, right? And they claimed a salary over the 3 years, totaling $500,000, $167 a year, right? And the rest they took out as distributions. And then I know of, there's been no audit of President Biden, everybody, over this by the IRS because apparently that was deemed to be reasonable. I'm only commenting on this because what's good for the goose is good for the gander. And nobody knows what reasonable means, everybody. So people are just using it to their benefit. Talk to your accountant about it. All right, next, everyone, 1031s. I'm telling you that as an owner, investor in rental real estate, teaching courses on 1031s, billions of dollars, if not trillions, have been saved over my career, all right, by the millions of 1031s that have occurred in this country to defer taxes, all right? So the principle, everybody, the code section has been around for over 100 years, all right? They are used by far more than just the wealthy, but definitely used by the wealthy, all right? And a lot of us are thinking that if they took away the 1031 exchange, a lot of properties would lose a lot of value because of the tax liability owed if you could not do the 1031. And I would tell you, both the prior and the current administration would like to diminish the benefits of the 1031 exchange significantly, all right? So invest in our PAC, everybody, invest in our PAC, invest in our PAC. In Illinois, there's hardly a farm that is sold that 1031 is not at least thought of, all right? Get up to Chicago, every commercial building sold, somebody is thinking of 1031. I shudder to guess how many of these things occur every single year, right? So this is not a lesson in 1031s, but by gosh, if you own rental property and you're going to sell it, consider the 1031 if you don't want to pay a lot of tax. Your instructor and his wife, everyone, paid $55,000 in 2022 on the sale of a beautiful Tucson, Arizona rental property that we built in 2004 and sold in 2022. All right. And I was going to do a 1031. Kay and I were going to do a 1031. My wife became deathly ill in the middle of it, everybody. And I had bigger things on my mind than that. She totally recovered. But the point was that I just did not have the mental capacity to do a 1031 exchange at that time. And it cost us $55,000 between the federal government, the state of Illinois, and the state of Arizona. It is what it is. All right. Now, class, the real estate professional rule. Hear me out on this if you would. This is a rule designed to help people in the real estate business who own rentals. People in the business of real estate who own rentals get their full deductions every year. All right. Now, I could talk for an hour on this, and I'm not going to, obviously, but I'm going to give you a good example. Kay and I have very good friends, everyone, that are euchre players, all right? And if you don't know what euchre is, class, it's like strip poker, right? So there's humor for that. No, it's not, everybody. I did that just to get you to smile. Come on, Charlie, smile, all right? Euchre is not strip poker, class, all right? Okay. Okay, sorry for the bad humor. The bottom, I'm sorry, I thought that was funny, all right? And if you knew our friends, they would just laugh at me for saying it. He is a doctor, she is a nurse, all right? And through my wife, over the last 15 years, they have bought probably 10 rental properties, all right? He is a doctor, she is a nurse, a married couple. Kay and Chris are fully involved in the business of real estate, right? Everyone, Kay and Chris are considered real estate professionals. Our friends who are not clients of mine are not, all right? We get to deduct all of our deductions every year on our rental real estate. They may not be able to. They may have to carry them over to later years, all the way up to the year they sell their properties before they can take a deduction, if not sooner, all right? Now, this is completely thanks to NAR and RPAC, everybody. Invest in RPAC. In 1993, effective 1/1 of 94. So we have been, this has been around for what, about 30 years now, all right? That we've had the real estate professional rule to our benefit. So what are the requirements? All right, first of all, look at the slide, the right-hand side. In a year you have losses, like that year we wrote off the 66 grand, everybody, the year we wrote off the 66 grand, all right? We had a loss on our rentals. Because we are real estate professionals, we could deduct the loss. Our doctor friends and nurse friends could not. They would have to carry that loss over. So the three tests to be a real estate professional are: first, you have to be involved in real estate more than 50% of your time. You don't have to have a real estate license, everybody. You don't have to be a realtor. You don't have to have a license with the state of Florida or Illinois, but you got to be involved in your real estate for more than 50% of your time. For example, every one of us knows people that own a lot of rentals. They're not a realtor with NAR and they're not licensed with Florida. Doesn't matter, but if they're spending more than 50% of their time managing their rentals, they meet test number 1. And they must meet more than 750 hours a year involved in that business. And third, everyone, they must manage their own rentals. This is called the material participation rule. If you, as a realtor, you got to meet all 3 tests, right? If you as a realtor meet test number 1 and number 2, but have a professional manager managing all of your rentals, everyone, you are not going to meet the real estate professional rule, all right? So there it is in a nutshell, class. Our friend, the doctor, and his wife, the nurse, all right? If they have a loss in a given year, cannot claim that loss. They must carry over to the following year. And if they have a profit next year, they can write off the loss next year against that profit. But if they have loss, they may have to wait until they sell the properties to be able to claim the loss. It's not that they will never get the deduction. They just don't get it in the year they actually incurred it, like would happen with Kay and I. Now, the other side of this, class, don't overblow this, don't overplay this. If all of your rentals show a profit on your tax return a year, then this is an immaterial issue, all right? This only is necessary, this only comes into play in years you have losses, all right? And class, over 30 years of owning rental properties, I've had some years of losses, some years of profits. And the key is, because Kay and I are real estate professionals, we were always able to deduct the losses in the year we incurred them. That's the beauty of this, all right? Again, everybody, thank NAR and RPAC for this. They are solely to credit for why we are covered. Now, take this with a grain of salt, everybody, because a very good friend of mine in Florida, we just lost her husband, and you all know who I'm talking about recently, all right? And then everybody, a friend of mine and a fellow CRS instructor, retired, Frank Kowalski out of Miami, just passed away this week. And I think most of you are aware of that. And here's the deal, class, all right? This is about inheriting assets from a decedent, all right? And it's called stepped up basis, all right? And let me just take you very quickly to the essence of this, and then I'll back into it, all right? Look at this if you would. And remember, you're getting a PDF of everything you're seeing here. Dad bought a rental property 20 years ago for $200,000. And over the last 20 years has depreciated it 150 grand, has depreciated it down to 50,000 bucks. Right? Everybody go in. This could very well be a property in Florida somewhere. Right? He bought for 200 and he's written it down to 50 grand through depreciation. Dad died when that property is worth 490, right? And you were the sole heir. Everybody, you receive a stepped up basis in that property to 490. Meaning, you want to sell that property for 490, you owe no tax on it whatsoever. You want to depreciate, you want to rent it out again, everybody, you want to rent it out as rental property, you can start depreciating 490 all over again, just like Dad did, all right? So the issue is called stepped up basis. Now, go back a slide, all right? Look at the left-hand box. For inherited property other than tax-deferred investments like IRAs and pensions, the new tax basis to the inheritor for inherited property is generally the fair market value at or near the decedent's date of death. I literally just worked on this with a client in the last month. This issue is most significant both for federal and state taxation. And this is the way that fortunes are left to individuals when inheriting property from decedents. And I would tell you this, class, the current administration in Washington, and I'm not criticizing ever, I'm just making a statement. The current administration in Washington sees the wealth transferring from one generation to the next and wants to put a limit on the benefits of stepped up basis. I'm just telling you what I've read. That's all I got to say. Hadn't happened yet. Who knows whether it would ever happen, everybody, but the challenge apparently is going to be made, and then we'll have to see what happens. All right. Now, clearly the water gets muddied when we have a married couple filing, or married couple that owns assets together, everybody. For example, joint tenancy with the right of survivorship. And there are 9 common law states where the rules are different than the other states that are not common law. I said that wrong, everybody. I take that back. I used the wrong term. There are 9 community property states, is what I meant to say, all right? And the remaining states are not community property. Well, the 9 states include Arizona, Florida, gosh, guys, I'm talking too fast here, all right? I correct myself again, I apologize, all right? The 9 community property states include Arizona, is what I meant to say, and California, and others, but Florida is not a community property state. I looked this up this morning, class, right, just to make sure, right? So the problem when you own a property in Florida with a spouse, joint tenancy with right of survivorship, the water gets muddied as to what the new basis is to the surviving spouse. And everybody, this should clearly be the case in my good friend Alexis Boland's case, who just lost Mike in the last several months. All right. And I'm not going to try to answer all those questions. I'm just going to tell you the water gets muddied there, where it's not so muddied if you live in a community property state like California. All right. But everybody, and you all take this the right way, but I have a dork sense of humor. Death is good from a tax standpoint because the inheritors receive a stepped up basis. That's the benefit, class. Simple as that. All right. So it doesn't apply to pensions and IRAs, things like that, but everything else. All right. Now, a big issue, class, a big issue. Now, watch my point, class. Look at my hands again, if you would. And this gets to a higher level thinking. Remember that 8-year span of time, 18 through 2025, all right? So what happens is this, class, right? The federal estate tax exemption continues to rise through from 18 through 25. And then on 1/1/26, apparently gets cut in half. So we project that the federal estate tax exemption, which was 12,920,000 per the slide in 2022, which is about 13,800 something in 24, and will go to about 14.5 million in 25, will be cut to about 7 million in 2026, right? And I don't look for this to get changed. Everybody, I think it's going to go up and then back down to about half of what it is, because I think the current administration thinks that people with a lot of wealth should pay tax upon their death for infrastructure, things like that. It is what it is, right? But here's my point. I'll guarantee you across the country, class, right now, that very wealthy people are doing very substantial gifts to use up as much of that difference between 14 million on December 31st of 2025 and 7 million on 1/1/26. They're using as much of that up through substantial gifts to heirs so that they don't lose it when 14 million drops to 7 million. All right. So that's what I'm trying to say. And look at the gray box if you would. Planning opportunity, if you have substantial net worth or have parents with substantial net worth, you should be talking to your estate planning attorney to consider making substantial gifts to your heirs in 23, that's gone, 24 now, and 25 before 1/1/26. And I'll guarantee you, class, the wealthy in this country are already on this. Their attorneys are already on this. So this should be nothing new other than making you aware of this. And the humor here, class, is this is much more interesting if you have wealthy relatives than if you don't have wealthy relatives. And that's my humor. So it is what it is. Okay, now I can skip this next one, class, but now moving on, I want to make sure I get, and Charlie, how much more time do I have, Charlie, before you ring my bell? Just let me know. Anybody? Charlie?
Chris, I'd like to give everybody in attendance and on Zoom a chance to ask some questions. Unfortunately, Alexis woke up sick this morning, and she's usually a good instigator of questions that people want to get answered that don't speak up. So you can take as much time as our guests want.
Okay, how much time do I have to speak before I open this up to questions, Charlie? That's my question to you.
I would say another 5 minutes.
All right, very good. All right. So, and I can summarize what I've got here. And always, class, I have more in my presentation I'll ever get a chance to talk about, but that's better than the opposite. So for those of you really hitting a high note on commission income, you need to think beyond the SEP IRA and the 401k class, which I'll cover in just a minute. The cash balance defined benefit plan is literally out there. And, you know, with a SEP IRA or 401k, the most you can put away tax deductible is literally $66,000 in 2023. But there's really no limit on how much you can put in tax deductible into one of these things. I've seen people put in 150,000, 200,000 bucks. And look, as I take you around this sequence of boxes, it's for the high income and disciplined earner, right? Allows for tremendously higher contributions and deductions. More expensive, you got to hire an actuary to come in and calculate how much you can put in every single year. Many people shy away from this because of the load on this, the amount they got to put in every year. A lot of people are not that disciplined to do that. All right. And the theory of this, everybody, instead of defining the contribution, which is $66,000 to a SEP IRA or 401k, the cash balance defined benefit plan defines the benefit, everyone, of how much you want to draw when you retire. And that's what makes it such a bigger plan. And I've had a couple of people back in Howard Brinton days, everybody. Howard's now passed away 8 or 9 years ago. But I did a lot of consulting for he and his stars when he was still alive. And some of those stars have come back and said, Chris, thanks for introducing this to us, which all I did, right? Because they're retiring with $4 to $5 million in their cash balance defined benefit plan. It'd be tough to get that much into a SEP IRA or a 401k. All right, now the past fluidity tax loophole is not a Florida issue, everyone, so I'm not going to cover that now. What I want to do is I want to get to a couple of other issues very quickly. First of all, class, there's a huge deduction out there for buying the right kind of vehicle, right? And I'm shortcutting this, but all my outline supports what I'm going to talk about. And I'm going to go right to this very quickly. The issue is whether you want to buy that pickup truck or that heavy SUV. This has been around for 30 years, class. I've been teaching this the same for 30 years. So to be classified as a heavy SUV or pickup truck, it's got to have a production plate that says in the upper right-hand corner, GVWR, gross vehicle weight rating of more than 6,000 pounds. So 6,000 or less doesn't get it, 6,001 does. And in this case, class, you see GVWR is 6,950. In this case, it clearly qualifies. And what does this get you? All right. What this does, everybody, and look at this vehicle or look at this vehicle. And these are just examples. All right. So, the pickup truck or the heavy SUV. And if you bought this for 60 grand, new or used, here's your choice: depreciate that 60 grand over 5 years, or write the whole thing off the first year. No ifs, ands, or buts. All right. And I'll guarantee you, I'm responsible for selling 500,000 of these over a 30-year career by people who went to see their accountant in December. And the accountant says, I got good and bad news. Good news is you made a lot of money. Bad news is you owe a lot of tax. And the dealers load up on these vehicles in the last quarter every year, class, to qualify their buyers for that big vehicle deduction. Now, I'm not for this personally, class. I've already joked about this. I'm 5'5", weigh 155 pounds. All right. I have to have a step ladder to crawl into one of the darn things. All right. Now, before I end this, I want to just talk about this, class. I'm a certified financial planner. You got to put money away. You got to have an exit strategy, class. And if you've got a spouse with a job and they've got a good 401k, that's fine. All right. But by gosh, the number of times I've seen a split in these marriages, class, and I just literally answered an email before I got on this call this morning where a woman was complaining that her husband had taken loans out against their 401k. And I mildly corrected her and said, I'm sorry, but if he took out a loan on a 401k, it's his 401k, and he had every right to do that. And I hope under state law and marital law that you're entitled to some of his 401k in the divorce split. And that's, I'm not an attorney, so I went no further than that. But everybody, my point is, I would hope you'd be putting money into your own retirement account. Now, look at this if you would. I'm going to finish these 2 slides, Charlie, and I'm going to open this to questions. So here are the limits, class, this year on how much, and this goes back to last year because we're still working on last year, 2023. So there are the limits for the types of plans that you can put in and deduct on your tax return, all right? And notice, everybody, the SEP IRA looks like 66 grand and the 401k looks like 22.5. And these slides are a staple of mine every single year. So if you were with me a year ago, you've seen these. They just updated to current numbers. Now, I want to end with this particular slide. Now, I like the 401k, everybody, which is the orange across the top, versus the SEP, which is the bottom row, all right? And notice, I've got 3 columns, 50,000, 80,000, and 220, all right? Trying to get to as many of you as I can in this webinar, all right? So look at the $50,000 column. The most you can put in tax deductible into a SEP IRA is 10 to 12,000. And the most you can put into a 401k on 50 grand is 35 grand. If you make 80, the most you can put in tax deductible to a SEP IRA is 16 to 20. And the most you can put into a 401k tax deductible is 42.5. And everybody, clearly you could put more money into a 401k. And the other benefit is that if you're 50 years of age or older, which most realtors are now, class, you can put an extra $7,500 into the 401k that you cannot put into a SEP IRA. All right. And here's the deal. In closing, class, I implore you to do this. What's your exit strategy from this business of real estate? It can be investment real estate. That's Kay's and my exit strategy. We are 75% in investment real estate, 25% of the stock market. And we're real pleased with our stock market right now, class. Who isn't with what's happened in the stock market in the last 12 months in this country? All right. But 75% of our portfolio is in real estate, and the other 25% is in the stock market. I leave that to your choice, what you want to do. It's your money. But if you're looking for tax deductions and going into conventional retirement investing, meaning stocks and equities, the 401k and the SEP IRA are choices you can make. And simply put, everybody, you can generally put more money into the 401k. Now, having said all of that, Charlie, I'm now going to the chat to see if I have any technical questions. And then let me clean these up, Charlie, and then I'll open this up to the general public. All right. So I'm going back up here. All right. Okay. So the first question I've got since the last ones, if I want to 1031 my rental property, 950,000 that has a 500,000 loan, can I just exchange for a 450 property with no loan and pay boot just on the 500K? Well, here's the deal, everybody. The problem is what this creates is in a 1031, you have to go value to value, sold value to purchase value, right? So 950 to 950. And you have to go loan to loan, right? So if you had a $500,000 loan to do a totally tax-deferred exchange, you'd have to go 500 to 500 or more, right? You can't just cash out of the old and spend, and that's not what he's asking. All right? I understand the question. When you cash out of the old and only want to spend the net proceeds in the new, everybody, that's really going to cause you some tax. You've got a partially deferred, and this is what he's asking about, and a partially taxable exchange in the situation that he's given me. Now, here's what we don't know, right? The one thing that's not given to me there is his basis in that property he's selling, because the difference between the 950 and his tax basis is going to determine what percentage gets taxed on what he's trying to do here. All right. So that's a really, really good question. All right. Next. I'm trying not to miss any questions. Hurricane Ian caused rental losses and helped to shelter my commission income. Everybody, that's a wonderful comment. And to the person asking me that or making that comment, I replaced 2 roofs, everybody, because of Hurricane Ian. And the insurance company paid half on each roof because they were about 18-year-old roofs. But the person asking the question or making the comment was that did cause rental losses, and therefore being a rental real estate professional, everyone gave her the ability to claim those losses. But if my friend and his wife, the doctor and his nurse wife, had the rental losses from Florida Hurricane Ian, everyone, because they were not real estate professionals, they would not have qualified for the deduction of the loss that year. And Mary Ann Lilly, I'm going to give you a compliment. I'm going to call you out on this because you asked the question. Everybody, be aware of this, and very little talking about this right now. But Floridians, listen to me on this, please. And this has nothing to do with what I've talked about, but everything to do with maybe what's going to happen. All right, watch my hands. There are regular hurricane losses, everybody, and then there are what I'm going to refer to as super hurricane losses. All right. And the super hurricane losses are called qualified disaster losses. And I want you to be aware, and when this happens, if it does happen, I'll be on CRS doing webinar after webinar on this, especially for my Floridians. A qualified disaster loss, the big one, gets much bigger deductions than a regular disaster loss. HR 7024, that is not passed yet, everybody, wants to go back and make every hurricane loss since 2021 a qualified disaster loss, including Hurricane Ian, which is going to make Charlie the loss much larger than what a lot of people have claimed. And I don't know who just said something, but I'm only doing that in respect of Mary. I don't know what's going on. All right.
You need to see my
Uh,
pretty face. Thank you.
Tammy's asked me, does this mean the kids receiving the gift don't have to pay? Guys, let me make this comment very clear. Gifts are never deductible by the donor, and they're never taxable to the recipient. That's what Tammy's asking. Class, one more time. Charlie, you need to mute everybody.
You gotta
Charlie,
bring
because I'm getting a lot of feedback, but don't mute me, please.
Have a blessed day.
Okay, one more time. All right, to Tammy's question. All right, gifts are never deductible by the donor, and they're never income taxable to the
Head
recipient.
right
That's
onto State Route 44. Then turn left onto County Road 229.
Somebody's getting GPS instructions. Okay, a person is commenting. The speaker discussed various tax strategy deductions that can help real estate professionals save on their taxes, including depreciation, bonus 179, etc. Qualified business, all right? Somebody's summarizing what I did, summarizing. All right, very good. What if your income is above the contribution limits to contribute to the Roth traditional? Okay, so Glass, now to respect Jane's question.
229.
Charlie, I don't know what to say, all right? But Jane, to respect your question, what if your income is above the contribution limits to contribute to the Roth traditional? Then what you do, Jane, is do what is called a backdoor Roth. And that means you contribute to a non-deductible Roth, which there are no income limits, and 5 minutes later, convert that over to a Roth IRA. That's called the backdoor Roth, Jane, to answer your question. Financial planners do that left and right every single year, right? Can you still contribute to a SEP or 401k for 2023? Barbara, excellent question. I meant to tell you this. The reason I bring these up, everybody, is you can now set these plans up now and contribute to them for 2023. So you put the money in a SEP IRA or a 401k in 24 now and deduct it in 23. But you need to get on this pretty darn quick. What next? As a sole proprietor with rental property, what would you recommend as an exit strategy? Marianne, there's so much that I would need to know to answer that question. But to respect your question, at least I'll try to do this. My wife and I have 4 kids, all right? And we have a bunch of rental properties, Class, and my exit strategy is at my demise, everybody, if and when that happens, will most likely statistically before my wife's demise, all right? So then at her, I die, everybody, she lives on the cash flow, our savings and things like that. She has a very comfortable retirement. She probably places the property with property managers, all right? And at her death, Marianne, I would love my exit strategy for my wife and I, for our 4 children, to inherit all of our rental properties if they are of the mindset to do it. But my strategy, Class, is to teach another 2, 3, 4 years until I just don't want to do it anymore. Retire on our savings, our 401ks, our income from our real estate, enjoy retirement class, travel, things like that, and then leave a respectable amount to our kids. All right. But Mary Ann, that's just fluff from me. I need to know more specifics about you to really answer that question. So Charlie, I've answered all the questions I've got. So I'd be more than happy to open this up to anybody who wants to verbally come in on this, Charlie, and ask questions.
I believe Christina has her hand up on the Zoom call. Did you answer?
Christina?
Yes, I have a question. So,
Yes, ma'am.
I actually have a full-time job. I work as a property manager, for a vacation rental company. I do
Good.
real estate, part-time, so I spend about 20 hours a week, as a realtor. And I also have, I self-manage a long-term rental. Am I able to use the rule for offsetting, loss of my long-term rental, the losses that I have from my long-term rental and offset some of my commission income?
Totally understand your question. What you're asking me is if you qualify as a real estate professional. And here, and I,
Yes.
from what you're telling me, doubt you do. Now, here's what it comes down to. Do you spend more than 50% of your time in the business of real estate, or do you spend more than 50% of your time on your full-time job? That's the question you can go ahead and answer.
Well, that's a complicated because it's like, I really like what do you qualify as a time really? Because like I have a full-time job and I do real estate part-time, but I still do more than 750 hours per year.
Yeah, but
So
understand. Just let me interject, okay? Just to keep it short. A
yeah,
full-time job would be 40 hours times 52 weeks is 2,080 hours. This is tested all the time in the tax court by the IRS. So if you've got a full-time job and you're spending 2,080 hours there, you've got to be able to prove that you're spending 2,081 hours in your real estate business. All right. And remember, it's all three tests. It's not just one of the three. It's more than 50% and more than 750 hours, and you manage your own rentals. And I would say if you keep saying you've got a full-time job, and I'm going to equate that to 2,080 hours, I doubt you're spending 2,081 hours in the business of real estate. I'm sorry to say.
I don't. I spend about 20 some hours a week, so I definitely don't. I don't spend full time. Like I don't spend another 40 hours in as a realtor. I mean, there's not that many hours in the week for sure.
You'd have no, and I'm going to tell you, you will not qualify as a real estate professional.
Okay.
Chris, can you explain to
Sorry.
everybody on the Zoom call, if you could explain to everybody on the Zoom call about how they received the PDF?
Well, number one, Charlie, I'm going to send it to you or Alexis is what I'm going to do.
Okay.
I'm going to send it to one of you this afternoon for you to disseminate it as you so wish.
All right. I certainly appreciate it. It's been very insightful like it is every year, and we look so forward to doing this. Are there any other questions within the Zoom audience? So we're clearing out here.
Well, everybody, I want to thank you for your time. I've thoroughly enjoyed this. Get your taxes done because I know most of you haven't done them yet. All right. Charlie, thank you.
All right. Thank you. We'll talk to you later, Chris.
Good.
Thanks everybody for chiming in.